Yes, hello all, and welcome to finally a new episode of Blockchain Talks. It has been a while. A lot of things have been going on in the market, but they were, I'm not going to say on the boring side, but they were quite interesting. But I didn't really have the time to do live streams. Don't forget, these streams are all done freely. I don't ask for donations. Well, you can always donate, but there's no donations, nor am I getting paid for these. So anyway, yeah, all these live streams are for free. Let's head straight in and, well, let's do the traditional blockchain talk format. I'm going to do a small market analysis and do a little prediction on where things are going, how things are going, and what we might expect the forthcoming week or weeks. I'm going naturally going to zoom in on Bitcoin. By reason it is still the most dominant coin around. It will, well, decide how the markets will move. What do we see here? 24-hour trading volume. You see quite some volatility here, especially today. Major sell-off, up buy, sell-off, buy. Dips are being bought. There seems to be a nice resistance level here at around 24K on the 24-hour trading chart. Look up on the weekly. You can see we came on the weekly from a low of 23K, headed back up, and seems to have a support at around 24K currently. However, as I always say, start zooming out. Do not get worn down by such positive graphs on the short term. You always need to take a look at a bigger picture. What do we see here? 14 days or 2 weeks. Previous was around 23K. We went up towards 24K. On the monthly, these are the type of charts which become much more interesting. You can tell 24K on before was resistance level. Now it seems after some good correction, it has broken and we are probably trading at around it. However, I might say 23K even on the monthly is still your support level. Everything gets much clearer if we look at the 90 days, so that's about 3 months. Yeah, this is the June crash with Three Arrows Capital and, well, the various DeFi. We became illiquid, which saw a further correction downwards. And you can see there's some bullish sentiment going on. We are slowly on the rise. Now, this to me is an indication that the market is finally recovering from, since May, from the Terra Luna collapse, that it is finally recovering from Three Arrows Capital illiquidity, the Celsius network, which applied for bankruptcy, etc. All of them went hand in hand with a major dump of Bitcoin onto the markets. And what we are seeing here now is retail and institutional investors slowly eating back up the newly formed reserves of Bitcoin. And it translates into some better price action. Around 80 days, so as you can tell, earlier this year in March, 45K. This here is the Terra Luna sell-off, Three Arrows Capital, and now we are heading back up. So in and in itself, it is on the recovery. Now, something else I want to show you guys concerns Ethereum. It's going to be highlighted during this live stream, and we'll talk more into detail about it. But do know, currently, despite my saying that Bitcoin still has the highest dominance and will decide what the market is doing, do not underestimate Ethereum due to its second highest market cap. By reason, it is second highest for a reason. There is a lot of money involved. And with the merge coming forth, it is more or less leading market sentiments. As you guys can tell on the 90 days here, Bitcoin was less steep. Ethereum is rallying. Came from about half its value up to 2K almost yesterday. So it means something is going on. Ethereum probably is now influencing the market. That being said, let's head over towards the main topics of today. Let me start with Blackrock. The article: BlackRock makes crypto splash with private Bitcoin investment trust project. For those not in the know, a few weeks ago, BlackRock announced a partnership with the centralized exchange called Coinbase. That was a very first step, implying that BlackRock is launching itself into the crypto sphere, onto the crypto markets. Now, some people will applaud this move. Myself, I'm always a little bit wary. Yes, it allows for more dollars to enter the market. On the other hand, BlackRock is quite renowned to do some shady business. If you look at its history, and especially in the US concerning the housing market, they've been aggressively buying up lands, etc., etc. They've got billions of dollars in their hands. Billions of dollars that can influence the crypto markets, that can enter the crypto markets. People will always think, yeah, it will enter the crypto market. That's a bullish signal. However, do not forget, BlackRock is still one centralized entity. Them throwing in billions upon billions or millions upon millions of dollars into the crypto market also implies fair distribution of the coins itself will become stunted, especially in light with their co-partnership with Coinbase. It is something to watch out for. On the short term, you can see it as a bullish signal. On the long term, we need to be wary. It is a very big TradFi player. They have no qualms to leverage the market and leverage money out of the small retail investors' pockets. So whatever you do, especially since these guys are entering, hold your Bitcoin. Do not start trading on the risk or by signals issued by these guys. They know the game. They've been playing it for a very long time. And you, as a single-minded entity, cannot outperform the minds of literal hundreds of people dedicated towards trading. So be wary of this. Naturally, the title says makes crypto splash with private Bitcoin investment trust product. This in itself implies they are launching something akin to futures, ETFs, and options for Bitcoin, meaning they will probably hold Bitcoin in their very own reserves, but will allow people to play with options of derivatives of Bitcoin, meaning there is a tremendous amount of leverage coming in. Naturally, I'm talking only about Bitcoin here, by reason it still is the biggest coin. However, this will also reflect on the rest of the cryptocurrency market. Be wary about it. Do watch out. Let's talk about the Ethereum merge. Now, before I begin, I must admit, myself, I'm not all too big of a fan of Ethereum. In which sense? Well, I find that their transition towards a proof of stake based model is quite dangerous, and Ethereum itself in the past has shown to not really care about its very own community, that it has been hyped and that it has been built to such a level that there's a lot of leverage going on, that the Ethereum Foundation has quite a lot of influence. Not to say that they can take over the entire network more easily as soon as the merge or the transition towards proof of stake has taken place. Now, the Ethereum merge makes speculators very bullish on Ethereum. They're investing more money, there's more hopium, as you could see here on CoinGecko in the last couple of days, even in the last month. There's a bullish episode. It's not only because of Bitcoin, this is solely because of the merge which is approaching, which has been announced since several months. to be somewhere August or September. The article itself says, look, it's going to happen in September and probably slightly more early than expected. They are selling the news. However, there are a few things about Ethereum that you need to comprehend and why I am so wary about it, which I'm going to explain here in a series of tweets I've done in the past. So one from 5th of August, 2 weeks ago. It's a little discussion on Ben Armstrong or BitBoy making a claim, Bitcoin is never going above 50% again, what a time to be alive. Whereas I say Bitcoin will remain number one, lowering of its dominance has more to do with the high amount of new coins and tokens being launched and less with its importance. You have to understand dominance is based on the amount of different coins and tokens within the market. And naturally, you cannot hold a higher percentage if there's each time a new increment of new coins and tokens being launched within the crypto market. So, yeah, it's quite easy to understand, really. I'm not going to get deeper into it. However, as someone who said a counter statement like Ethereum will challenge that number one, here's a few valid criticisms. I doubt it because a lot of Ethereum is locked until Ethereum 2 is launched. Eth2 refers back towards the transitioning towards proof of stake. Since December 2020, if I'm not mistaken, you have the ability to start staking Ethereum in order to support the launch of proof of stake. That means a lot of Ethereum has been locked for 2 years for a very long time. It's a big amount. We're talking about literal millions of dollars worth of Ethereum being locked on-chain, unable to move. By reason, well, this has been planned, really. Ethereum itself said as soon as you stake Ethereum for the transition towards proof of stake, you cannot withdraw said Ethereum. It will be used for the merge. That's basically what I'm saying here. Can be verified on the Ethereum Foundation's website itself. This one dates back from, the bull run itself. Due to high gas fees, a lot of Ethereum locked and cannot be moved until transaction costs lower. This became very apparent in the bull run of 2020-2021, whereby gas fees were actually quite high. There was at one point you had a gas fee of about $100 that you needed in order to move an NFT or even your coin from wallet to wallet, meaning that all low numbers starting from $100 or less were locked in wallets. They could not be moved. Simple as that. And as a result of that, the Ethereum couldn't be moved and was locked on the blockchain, meaning, well, quite frankly, a lot of money has been saved due to faults of the Ethereum network of, well, fundamentals of Ethereum locked onto the blockchain, unable to move, which gave them or still gives them an overinflated market cap. People want to sell, people want to cash in, but they cannot move their funds. This is still the case, even though transaction fees and gas fees are now lower due to less activity on the network, due to, well, the current bearish, crabbish market. That's basically what I'm saying here. And that's what I'm saying here. The difference is locked up in a bad way, in the sense of people want to move it, but can't. The Ethereum merge to POS might see some gains, but heavy corrections will occur as people can finally catch out their accumulated Ethereum 2, not to mention heavy security loss. By reason, all that Ethereum is currently being staked and will be used for validation of the blockchain once it passes towards proof of stake. That's how validators work. However, as soon as you can withdraw, you lose your validation rights. You will stop supporting the network. You will start cashing out, which means the market cap will start to lower. Basically what I'm saying here. And here, this is a little news. Altcoins such as Ethereum are just scams. Mark has a rally support for Bitcoin, and people will say, but Ethereum has second highest market cap and so many things built on it. That's true. I will admit to it, which gives it a certain amount of credibility, in my opinion. But it's not truly decentralized. Its founders and devs are more in bed with VF governments than you might think. Bitcoin resists this. Ethereum complies. Perhaps a little bit of a shill from my part, but I've got good reasons to mention it, as mentioned here. Status. There's something else, a little tweet I am willing to share with you guys. Here I say, once again referring towards what I mentioned here. They know it concerns millions being locked. Ethereum, which people will start selling once available. Market cap is overinflated due to such mechanisms. I'm referring towards the staking option in Ethereum 2, currently still ongoing. True appreciation is much lower with leverage and while leverage and speculation is tremendously high. I'm referring and answering to this post here. And this is from an Ethereum developer. You know, the merge is the news event when Ethereum devs purposely let out withdrawals and plan on introducing a limited queue. This is a series of tweets they screen capped from an Ethereum dev. Right now, 23,263,160,000 worth of Ethereum is being staked, expressed in US dollars. That is about 10% of the entire market cap of Ethereum. 10% is being staked for Ethereum 2.0. Keep that in mind. So you might be wondering, won't everyone just unstake their ETH right after the merge and dump it? Their answer, no, Ethereum withdrawals are not currently implemented and are planned to be added in a post-merge software update. Meaning, if the merge occurs, you still can't withdraw your Ethereum, meaning they are holding 10% of their entire market cap fixed onto the blockchain, making it for all people who are staking their Ethereum unable to withdraw. Simple as that. So it's an overinflated market cap. People will want to move, but they can't. Their excuse, this was done due to separate the complexity of building, testing, and deploying the merge itself from a withdrawal functionality. Meaning they did not implement a withdrawal functionality despite them having promised it. Doesn't come. Simple as that. Current plan is the deploy of the withdrawal functionality in a software update 6 months up to 1 year after the merge. So in September, if the merge occurs, you'll probably have to wait 6 months up to 1 year before you can withdraw your Ethereum. Now, some people will mention or say to me, that's all right. It means I can earn more Ethereum on the down low. True. But at the same time, if you want to cash out, you do not have such an ability. And the ability is to have freedom with your money. You choose what to do with it. This is actually keeping your money hostile. You do not have the freedom to move it. This is them practically saying, yeah, we are in control of your funds. That's a very dangerous thing. Furthermore, also the withdrawal system will be implemented as a queue to limit the amount of Ethereum that can be withdrawn per day. Meaning, they not only keep your Ethereum that you've staked hostile, which leads naturally to an overinflated market cap. They're also saying, look, even if you want to withdraw and we've implemented, we are going to steer how much can be withdrawn per day or over a set time frame, because this still is very theoretical. Even the date mentioned here, 6 months to 1 year after the merge, is still theoretical. They can prolong it towards 2 years, 3 years, or never. It is entirely possible. This is the shit show that Ethereum is. It is a big bombshell. Do watch out with it. Hence why I mentioned taking what I've said here into account and here, that Ethereum is a centralized mess. The developers and the foundations are keeping your money for them. And I'm going to further show this little treat because it further gives an insight why I believe, why I'm convinced Ethereum is a centralized mess. In facts, these are all facts, can be researched on the internet through their very own sources. Ethereum was initially sold to the public by the foundation, between brackets, for Bitcoin. Sold 30%, kept 70%. Now they control both. A 70% Ethereum supply and the Bitcoin sold for the other 30%. As Ethereum price rose, they gained more ability to manipulate the market. Even with this massive power to influence BTC, force Ethereum to adopt hard forks, we can do transactions if they want, centralized. That's entirely within their power. By reason they have the majority of the Ethereum supply. So on the market, they still couldn't get Ethereum to overtake. Yeah, that's a little bit of a shield. So let's just say this part here can be forgotten. But they do have the power to influence the Bitcoin price and the Ethereum Bitcoin price itself, meaning they are leveraging. It is a dirty mess. Nobody knows how much of the Ethereum supply is owned by big players close to or on the foundation. It isn't clear. It can't be deduced from their blockchain. Even encourage big players to use multiple wallets to obfuscate identity. This doesn't even cover all the deceptions since it gets much worse from here, meaning a lot of the co-founders and initial founders of Ethereum probably have big bags of Ethereum spread across different wallets to leverage and play the market to their own game. That's a dirty trick. Small, despite Foundation marketing claiming it was a new decentralized internet, Foundation forced a hard fork to roll back all Ethereum transactions after an Ethereum-based DeFi platform was hacked. This can also be verified. It even stands on their Wikipedia page what happened. So this is dirty. And here, since DAO or since the decentralized organization, there's been about 15 to 20 billion worth of USD in DeFi hacks on Ethereum. Can be verified. Just look up on, wanted to say Coinbase, no crypto, Potato, CoinDesk, Ethereum hacks, and you will find plenty of projects built on the Ethereum network which are susceptible to hacks. All hacks, all funds being stolen on the Ethereum network. So note, hacks could also be the DeFi platform that's rug pulling users due to insolvency. None of the hacks since were rolled back like they did for the DAO. Why? Foundation was heavily invested in the DAO. Here's a little transcript. Please pause Ether trading as soon as possible. Why pause trading? Done. That's pretty serious measure. It's selling Ether moving. Okay, you guys can stop trading. Okay, let's stop the hacker from liquidating. So here is a little transcript from the DeFi hack that occurred on the Ethereum DeFi decentralized exchange, whereby they halted everything because the Ethereum Foundation was involved. That was one of the very first hacks. Afterwards, they've never done it, leaving people hanging dry and losing money. Further Ethereum news. New US crackdown has crypto users worried about their privacy. This one talks about Tornado Cash. This is a special program used to obfuscate transactions, meaning governments and banks, as blockchain is a public ledger, can see all transactions happening on the wallet of your choosing, meaning all transactions are publicly available. I was searching for my words here. Now, if you are moving funds, naturally it is entirely anonymous. However, with many wallets being connected back towards a centralized exchange, whereby KYC or know your customer mechanisms are implemented, you can deduce from whom a wallet is, meaning you only need to wait long enough for certain transactions to pass to a certain wallet, and if that wallet connects towards a centralized exchange, you can rest assured that there will be some kind of exchange going on, and that there's a higher probability of the user of said wallet being, the owner of said wallet. It can be done through centralized exchanges. I know this comes across very confusing, so I'm going to restart here. All transactions on blockchain are entirely anonymous, but as you are talking about a public ledger, all transactions can be followed. The second you connect your anonymous wallet towards your centralized exchange account, KYC is needed, is fixed on the centralized exchange itself, It pins an identity to a wallet, meaning people are able to pin your identity towards your wallet. Now, Tornado Cash here is a special program which obfuscates transactions, meaning if you have a hot wallet, meaning your identity can be pinned on it, you can make use of that service to make your transactions anonymous, as it will roll your transaction through a variety of wallets before having it enter in your final cold one. And with cold wallet, I mean one that isn't pinned to your identity, but is in your case. And the US government has done a crackdown and made Tornado Cash illegal. That's naturally an infringement on privacy, etc., etc. Naturally, the crypto community isn't all too happy about it, and proponents in favor of, yes, Tornado Cash has been suspended, the developer are being detained and arrested. That's good news for privacy, etc., and transparency. No, it isn't. What's being done here is government enabling themselves to pin and get an idea of your crypto holdings. They want to know about your finance for taxation purposes, etc., etc. Naturally, they are going to cover it and say, yeah, it's against fraud and it's illegal, yada, yada, yada. They do make a valid point somewhat, by reason some of these services are being used for scams and actually for fraud. However, fraud is always a little bit of a gray zone when it comes down to it, mostly because it's governments and bank deciding what fraud is, whereas some actions can be seen as, well, legitimately doing business and not wanting to share private company details towards, well, outsiders. In any case, this article is quite important. Tornado Cash developer detained, more arrests, not ruled out. They made the software illegal. However, the software itself is open source. The developer has nothing to do with how a program is being used. And people are celebrating this and say, oh yeah, the developer has been detained and more arrests will follow. So yeah, let's take on the culprits. No. Factual culprits are the people who make use of the application to do fraud. The developers themselves have nothing to do with it, except that they, well, naturally made the programs, and it could have been anyone else. So these arrests and detains, that's actually bad news. That's the invasion of privacy, and it just goes to show governments and banks are getting desperate. They are getting criminal. Anyway, that's my thing here. Further going down on it, one move the US government has demonstrated that they own Ethereum DeFi, because Tornado Cash was something built on the Ethereum network. Folks, do us all a favor, ditch the move to proof of stake so you don't hand consents to them as well. That way you will have to fight many more days. This little treat, we're going to read it. Still cannot understand how the Ethereum community has not put 2 and 2 together. Tornado Cash is your wake-up call. They have USDC, Infura, and most decentralized applications, meaning the Ethereum Foundation can roll back or censor all these mentioned. They do not have your miners or block production, because currently Ethereum is still proof of work, meaning proof of work is still the best consensus in order to be decentralized. They already have 6 and leader, VCs and node operators, 2+2. Meaning, with Tornado Cash, your transactions are no longer anonymous, meaning they can pin your identity. But what they do not have in hand is the very fundament upon which your blockchain works, being your consensus protocol, currently proof of stake. They have to battle against, well, a global group of miners performing work and sustaining the network. As soon as proof of stake has been launched, well, quite frankly, those miners disappear and validators will take over. And some might say, yeah, but the miners will probably present and become the new validators. Not immediately true. Remember what I mentioned here. Or even, sorry, was it here? Was it here? Yeah. In one of the previous things I've sold, yeah, here it is. Sold 30%, kept 70%. They still have a big reserve of Ethereum that they can start staking to overtake the network. Meaning, as soon as proof of stake has been launched, the foundation will have more power over the consensus of the Ethereum network. Some might say that's a good move. Me, on the other hand, I'm saying it makes it less decentralized. It also implies that the Ethereum Foundation becomes a centralized authority, which can be leveraged by governments and banks. So it's a very bad move. With that, I'm going to conclude it. Last topic. Is Solana really decentralized? A validator health report. Now, I've been talking about proof of stake, proof of work, and Solana is a cryptocurrency project which makes use of proof of stake. It implies it makes use of validators. And now, before I continue here, I'm going to show you what its market cap is. And I want you to keep in mind that market cap. In the top 10, and it has a market cap of $15 billion. It's quite a lot of money. When we are talking cryptocurrency and blockchain, you want to be as decentralized as possible in order to maintain the highest amount of security within the network. Some of you have seen it already, but there's only 31 validators needed to collude to compromise the network's consensus, meaning you only need a small group of people, one small company, in order to compromise the entire network. In reality, this number should be much, much higher. I'm not talking about 100 validators, no, I'm talking about a literal thousands of validators. That account, soon as you are with thousands of validators in order to compromise the network, you can say you're quite safe. 31, that's very, very few. Take a closer look at your article. Solana Foundation recently released its first report evaluating the health of Solana network. Its initial report digs into key metrics assessing the health of its validator network. These include its total validator count, Nakamoto consensus, and distribution. Per the Foundation's report on Wednesday, Solana currently consists of more than 3,400 validators across 6 continents. Validators are responsible for independently verifying new transactions and storing the state of Solana's ledger. Validators are broken into 2 camps: consensus nodes and RPC nodes. Consensus nodes create and propose new blocks for the network while verifying blocks proposed by other network nodes. In general, the more consensus nodes are there, the less likely chance there is for a user's transaction to be tampered with. Straightforward. Meanwhile, remote procedure calls, or RPC nodes, perform the same duties as consensus, but also provide an application gateway to Solana infrastructure. They provide convenient ways for users to interface with the core Solana network in a way that's specialized towards a particular application. Over 1,900 of Solana's validators are consensus nodes. Furthermore, an average of 95 consensus nodes and 99 RPC nodes have joined the network each one since June. There's a distribution. Meanwhile, Solana's Nakamoto coefficient is 31. This metric represents the number of validators required to compromise a network's consensus, commonly defined as 33.4% of the voting power. Quite straightforward. However, as you guys can tell, we are talking about 3,400 nodes in total, but how come only 31 are needed? Well, quite frankly, it says it right here. Relatively low Nakamoto coefficient compared to the validators count is due to Solana's proof of stake mechanism. Proof of stake puts greater influence over the network's consensus state in the hands of those who hold and stake more Solana. meaning it doesn't matter how many validators you have with small stakes. If you have your top 100 wallets of Solana holders who stake the most amount of Solana, they will have the bigger vote on the network, meaning that you will have this number of validators needed, making Solana actually quite unsecure. And it's being mentioned here as well. Top 100 Solhors alone control 30.81% of the total supply. Report note that none of the major data centers running Solana nodes comes close to surpassing 33% of the active stake. Meaning there's still some room for improvement, meaning that they leave it a little bit here in the middle on Crypto Potato by saying, yeah, it isn't really unsecure because, well, there's more fair distribution of Solana, which is all true. However, this is quite problematic. That number needs to be increased on the long term, which can only be done through further mainstream adoption, more people getting into Solana itself. However, that might prove to be quite difficult by reason Solana is quite renowned to have regular, well, timeouts, network going down, congestion, etc., etc. So I must say, Solana, I see it as a worthy alternative to Ethereum. However, it, like Ethereum as well, is riddled with faults and problems. With that, I'm going to stop sharing my screen and I'm going to end this broadcast. And I want to thank all of you guys for watching. Up until next time. Bye.